Property taxes can be a determining factor in every purchase. But have you ever wondered how are they calculated? This is Danny Manzano, and welcome to another episode of Apple Tower Talks. Tax bills are split into two types of assessments, ad valorem and non-ad valorem. The ad valorem section is calculating by multiplying the assessed value times a tax rate, which varies by city. The non-ad valorem section is based on fixed amounts determined by local services such as fire rescue, drainage, or community development districts, also known as CDDs. Adding both sections, ad valorem plus non-ad valorem, will result in your annual property tax. While calculating the non-ad valorem section may be pretty straightforward, the ad valorem section is tricky. In this series, we will break it down as simple as possible and discuss about property tax matters such as calculating the assessed value, millage rates, first year's taxes, appeals, exceptions, and why not real life examples. Let's dive right in. The county assesses property values once a year. While your purchase price will affect the property value, it doesn't completely drive it. All qualified sales that happen in your immediate area, which are known as comparables or comps, will be averaged along with your property and affect your final assessed value. The comps used in this calculation are those that closed prior to January 1st of the year in question. This means that if prices drop during the current year, you will possibly not see your assessed value drop until the next year, and obviously vice versa. It is important to note that the assessed value will probably be different from the actual market or resale value. Now, assessing the value is the first part of the equation. The next part is the tax rate, which is also referred to as the millage rate. You have to pay a tax to each taxing body in which your property is located. For example, your property might be subject to taxes by the county, the school board, a city, a hospital district, or even multi-county districts. Each taxing body will be allocated an amount as a tax factor. The sum of all these tax factors will constitute what we know as the millage rate. It is always expressed as dollars per thousand, and you can look this up in your county property appraiser's website anytime. Each taxing body is required to hold 2 hearings before they set the tax rate. They usually welcome responsible comments from taxpayers just like you, so make sure to attend if you believe your taxes are too high. Once you have both, the assessed value and the millage rate, you are now ready to calculate your ad valorem tax. It is then simple math. You multiply the assessed value times the millage rate. For example, if your property is assessed at $500,000 and your millage rate is 17.51, you would just multiply 500,000 times 0.01751 for a total ad valorem tax of $8,755. The county then offers exemptions to reduce the assessed value, which may or may not apply to you. We now know that your property will be assessed every year based on the comparable sales that happened the previous year. However, each county has different exemptions such as disability, widows, blind persons, veterans, military, etc. that can help the taxpayers save a few dollars, or in some cases even making them completely exempt. Check with your county's property appraiser to make sure you're not missing out on any discounts. And then obviously, there is Homestead exemption. This is available to anyone that is using the property as their primary residence, obviously subject to eligibility. While the calculation of this benefit is complex, the short explanation is that number one, it will reduce your assessed value by up to $50,000. And number two, and more importantly in my opinion, is that it will cap the yearly increase of your assessed value at 3%. In markets where values are rising exponentially, it is key to claim and maintain your homestead exemption and log that increase at 3%. Check with your county property appraiser for more information on how to apply and for eligibility criteria. If you haven't applied yet, what are you waiting for? Message us and we can provide you with the information on how to apply. Talking about Homestead, I did want to share a common story that we hear very often. It goes like this. My neighbor and I own identical homes. Both were built the same year and sit on identical lots. My neighbor bought his house 8 years ago, and I just purchased mine last year. My bill is $10,000 and his is only $7,000. Unfortunately, we hear this way more than we should. And it happens partly because the neighbor had his property protected with homestead exemption under the Saver Homes Amendment. This constitutional amendment, adopted by Florida voters, intended to prevent homeowners from being taxed out of their homes. Remember that Homestead caps that assessed value of the protected property at a 3% increase every year. In addition, it provides a tax savings of up to $50,000 off the assessed value of the property. Understanding the benefits of homestead exemption is key to locking your value. However, the first year of ownership is different because there is usually a portion that corresponds to the seller and another portion that corresponds to the buyer. Let's break it down. When you close your purchase, you inherited the seller's exemption status for the current tax year. However, since the taxes cannot be paid to the county until November 1st, there are some accounting adjustments that will happen at closing. Listen to this closely. If you close after November 1st, tax bills will be available. So always confirm that the title company is collecting the full amount at closing. In the event that your closing happens prior to November 1st, it will become the buyer's responsibility to pay the entire tax bill for the year of closing. Keep in mind, however, that as a buyer, you likely receive a prorated credit from the seller in the closing statement. That credit corresponds to the total days that the seller owned the property for the year of closing. In short, the seller gives the buyer his portion of the taxes at closing so that the buyer pays for the entire year once it becomes due. There is a lot of confusion with this topic, so it is important that the buyer understands it to avoid unnecessary surprises at the end of the year. Now, your eligible exemptions and the new assessed value kick in the year following your closing. Having said this, clients that pay their taxes in their monthly mortgage payment have to specifically be vigilant. Unless you are in a declining market, the property's tax bill will probably increase the following year of your closing. Now, keep in mind that if your taxes are paid out of the bank's escrow account, your monthly payment will also increase. This does not mean that your interest rate increased. They are just adjusting it to your new annual tax payment. Your lender is always required to pay your tax bill regardless of what the amount is. In the event that the taxes are more than what the bank collected from you, they will still pay it, but then come back to collect the shortage from you as the homeowner. Additionally, they will also adjust your monthly payment going forward to make sure they will have enough monies to cover the new tax payment. No one can really control this, but we should be aware that this increase may happen and again, avoid surprises. As years go by, you may not agree with your assessed value, and that is okay. There are ways to appeal your annual assessment. The county mails your tax estimate or trim notice between July and August. In it, you can confirm that your exemptions will be applied and review your proposed assessed value. If you believe that your taxes are too high, exercise your rights as a citizen by speaking out and attend those public hearings listed on the trim notice. Now, if you believe that your assessed value is also too high and you have the funds to support it, please contact your property appraiser's office and ask to talk to a deputy appraiser. You must file a petition with the Value Adjustment Board before the mid-September deadline. Once the tax bill is issued in November, it will be too late to file an appeal. Taxes are not usually a popular topic, but we should know our options to minimize our tax exposure. If you need more information on this topic, please message us and we will gladly provide it. I hope this information comes in handy and that we help you understand how your property is assessed. Thank you for watching, and as usual, like, comment, and follow us for more great title content. See you real soon. Take care.